It's one reason why Chinese oil imports were weak last year is that the country is importing an awful lot in the energy transition. More EVs on the road, EV penetration rates over 50% now. They're increasing grid spending on the grids and renewable massively, and that on its own is really carrying the copper market. So from my side, when I look into next year, granted, if you have got economic headwinds in a country like China, 50% of demand, it's not great. But what really matters is that we continue to see some of that energy transition spend coming through. And in a way, copper is exactly the other side of the coin of that less constructive oil market that you get from that. Europe doesn't help either. Clearly, when we look into early next year, that's why we take it all together. That's why we downgraded prices a little bit. But overall, when you're looking at the metal markets, they're actually not that weak fundamentally.
So indeed, there's always the two sides of the equation, right? Demand and supply. So while economic weakness might mean lower demand, if there's also lower supply, it could mean some bullish countermeasures or counter influences, I should say. When you look at how an investor might make money in the commodities market next year, Michael, which particular commodities have bullish fundamentals?
Now, look, as I said, I think we're looking at cautiously into the first quarter and the second quarter. But overall, when you take just the supply side, the copper market looks extremely tight. We just had contracts for 2025 signed. Under that contract, the miners decided how much they want to pay the smelters to process the mine supply. And those terms have come to all-time lows. The miners are really squeezing the smelters because they know that they can't source the mine supply. Similarly, on the aluminum side, we have a lot of issues in terms of operating costs. For instance, alumina prices have shot up over the past few months. Bauxite prices, all feedstock for aluminum smelters have gone up as well. The Chinese smelters are probably discussing now whether it makes sense to run marginal operations versus actually shutting them and then taking a hit when you're restarting them. And the longer those operating costs are as high, the closer you get to actually cutting production. On top of that, the government has imposed anyway a 45 million ton capacity cap on the aluminum market as well. And that limits the supply increases that you can come through there. So on both of the metals, you actually don't need an awful lot of demand growth to come through to make those markets tight or even push them into a small deficit.
Yes. Michael, turning to the geopolitics, if Assad is now being toppled in Syria, how does that change the narrative towards gold? And does the geopolitical risk premium unwind from the price?
Look, you can certainly argue both ways. If I look at some of the commentary that has come out towards Russia, if you did get a settlement one way or another in Ukraine, look, that from a geopolitical standpoint would certainly not help gold prices push higher. But the other big story is still de-dollarization, right? And you've seen the latest data from the PBOC or from the Chinese government. After a 6 months hiatus, the government stepped back into the market and actually increased gold reserves. And it's not the only central bank that is actually doing that. So similarly, yes. I think to the base methods, we are repricing Trump presidency at the moment, and that is what higher rates, stronger dollar is what takes prices down. But there is actually a supportive undercurrent still out there.